Hey, what's up, guys? I'm going to show you pretty much the whole process if you're doing the BRRRR strategy. I'm going to show you how to get the property into the books, and then we will go through some transactions, and then we'll go through the refinance part of it. So, with anything, we always want to start with the journal entry. Anytime you get a new property, you want to record it as a journal entry so you can get all of the information from the HUD statement. And I have a sample here. So that's the refinance. Okay, so as any HUD, it's probably going to show, pretty similar to this. And it's going to give you, the purchase price and then all of the closing costs. So always make sure the date is right. And for this case, I'm going to demonstrate everything in 2025 so we can have just a clean balance sheet to look at. And then I always like to label my journal entries so I can easily find it if I need to. So we'll say this is the purchase of 123 Main. And then we'll start with the purchase price, and we want to break it up into the land and building. So the land, I'm just going to say it's 25% of the purchase price. So it's 134,000. And then we'll say 25% of purchase price. And always make sure you want to consult with your CPA so that you can get the right number in here. They can decide how much to allocate towards the land and building. So the next category will be the buildings, and these are all under a fixed asset. So when you're setting this up, just create like a parent account, and then you'll have land, buildings, closing costs, and then capital improvements. And then, at the end of the year, you'll have the depreciation. But right now, we're just getting the property into the books for the first time. So we're going to do the building, and we're going to do 75% of that purchase price. Okay, and then make sure that your class is in here. If you haven't created it, obviously you'll add a new one and then just put the property name in here. Okay, so now we're at the deposit, and this is the earnest money that we put down to at least get everything started. So let's go ahead and we'll save this for now. And we'll go into our bank transaction. So here's our wire before, we even got the actual property. We put the money down so that we can have it held for us. So we'll say it's just this title company, and then for the account, make a purchase deposit account for other current asset. Make sure your class is in there. We'll post that. And then when we look at the balance sheet, you'll see this purchase deposit here. And if I expand this, let's do it by class. So if you have multiple properties, that's why the class is important. So everything can be separated. But you'll see the purchase deposit here for 123 Main. Okay, so let's go back into the journal entry. And we'll just continue on here. So we're at the earnest money. So now we get that money credited to us. So you'll do the same exact account, purchase deposit, and that'll be credited 5,000. All right, and then we have another closing cost for $425. So now this will be the first time that we put anything towards the closing costs. Closing cost credit. And it's good to just copy things as you go. You want it to reflect the HUD as much as possible. So now we have the loan charges, which will be a closing cost. Now this one will be different. So what we're gonna do here is we have the processing fee of $13.50, and then we have the origination fee of $24.58.13. So we'll add those two together. Now this here, the escrow and construction, I actually skipped a step because we didn't put the loan or the taxes in. So let's go ahead and get the loan in. So because this is a construction loan, we're going to have this escrow account. So they're going to hold this amount here, the $66,600, and that will be the amount that you can start taking draws on as you're doing renovations. So the total loan amount, you'll want to make a current liability as construction loans payable, and this will be the full amount that you're borrowing from. So we have the $196,650. And this is construction loan. And we'll go up, move it up to here, and then we missed the taxes. So I'm going to put this as a closing cost. This is something that you should consult your CPA about as well. I think usually it goes to the P&L, but in my case with this client, my CPA just said to put it all towards the asset, so it could all just be put onto the asset for depreciation over the life of the loan. So once they refinance it and put that property into service, then after that, any kind of interest or tax will go straight to the P&L. So for now, this will go towards the closing costs. Okay. So now we have our loan, and then we have these other closing costs, and then we need our escrow. And I'm setting up two accounts. So we have a construction escrow funds held, and this will be other current asset. This is for $66,600. And I'll show you why I'm creating two different accounts for the escrow, just to show you what it looks like on the balance sheet. But so once we get the escrow in there, everything else is pretty much a closing cost. So you can just add them all up and put it into one account if you want. So let's do this real quick. We had the 166, 719.65, and the 1050. And then the interest is the same thing, so you want to talk to your CPA. That could go straight to the P&L, but we're just going to put it towards the asset as a closing cost. And then we have all of our settlement charges as well. And then I'm going to go ahead and put the assignment fee in there as well. So the $17,476.47, and then the notary fee. And then we could just label this recording, interest, and settlement charges plus miscellaneous. Okay. So now that it's all recorded in there, we have the total amount here that we're going to pay from our bank account. So this amount now should match. So if you put your checking account that you have on your books, this amount should match what the settlement has, $23,503.56. Okay, so that's how you record the journal entry for the purchase. And then, when you come into the bank feed, you should have this amount that you paid to the title. Normally QuickBooks will pick it up and you could just match it, but if you have to do it manually, you'll click on this match here, and then you'll see your journal entry. Let's go ahead and match that. Okay, so if we look at the balance sheet, we now have the escrow funds held, and then this purchase deposit is at 0 now. And then we have the actual asset. So we have our total closing costs plus the land and building. And then we have our full construction loans payable. Okay. And let's actually go into the chart of accounts so we can correct this as well for our escrow. So we have our construction escrow funds held, and then we have another one that's a other current asset, that's construction escrow draws. And I'll show you what that looks like, but we're going to make one more as just construction escrow. And we want this to be the parent account. Okay. We'll move these as a sub. Okay, so those are set up. And now let's do a couple transactions. If you haven't used product and services before, then this is important because you can get specific job costing reports when you're doing renovations. And why that works is because everything is going to the asset under capital improvements. But if you want to see those details, then you have to use this account right here. So most of the time, if you're coming into your QuickBooks, you're only seeing like these accounts right here. And instead of using the general categories that you already have set up, we're going to set up product and services. So how you do that is you will come to the gear icon, and you'll first go into your account and settings, and you'll click on expenses. Right here it says show items table on expense and purchase forms. You want to turn that on, and that's how it pops up on the bank feed. And then once you do that, you'll come back into this gear icon and then click on product and services. And then you'll create the accounts that you want for your job costing. Whatever makes sense for you. Get with your client if you're a bookkeeper, but this is where you set everything up. And then, if you are creating one, you'll name it whatever makes sense. And then come down to this purchasing here. And the expense account, that's where you would put it towards the asset as capital improvements. Okay. And then, you can put it in the sales here as well. If you watch my other video, you'll understand like why this would make sense to do it that way. But, this isn't really necessary for what we're doing right now. The important part is the purchasing, and then make sure it goes to capital improvements. And then once you have those set up, now you can start categorizing things as you're buying stuff for the renovation. So we'll just do a couple here, like a Home Depot run. Instead of this account here, you'll go to the product and service, and then we'll say, it's electric. Make sure your property is in the class. We'll do a Lowe's. We'll say this was for plumbing. And we'll say we paid a contractor for his services, for his labor. So we'll have a subcontractor labor. Okay. Second part is, you might need more cash from that escrow account. So let's do a couple deposits here. We'll actually just do one for now. So when you get the deposit, you're going to put it to that escrow draw account. And then we'll have it to that property. Okay. And now let's look at the balance sheet. So now we have our total escrow funds that were held at the purchase of the property. And then this is the total that we've taken out so far. And now we have the total for that escrow. So you're always going to have this balance at the bottom here. You can have this as one account, and then this 45 would just be the construction escrow account. Me personally, I like to see both sides of it so I can easily tell how much has been taken out throughout the project. And then you'll see the capital improvements number is going up. Okay, so if you click into here now for the expenses you've paid for Home Depot, our subcontractor, and the Lowe's, everything's under one account so far. So, this number is important. You want the total, but from this report, if you come over to customize and you scroll down to groups, you can change it to product and service. And now you're going to get your details in here for your job costing. Now it's all broken up the way you would like to see it. And yeah, that's a cool report that you can use for product and services. So that's why you would use that. So now let's go back into the bank transactions, and let's just go ahead and do the last draw. Let's say we take the second draw out of here. We'll post that. And now we're pretty much done. We finished the renovation, we made all of our payments, and we're ready to refinance. So if we just quickly jump in here to show you the escrow, now it's at 0. Okay. I don't know how common it is to use all of the escrow money, but in this example, we're just going to say we used all of it. Okay. So now we're going to refinance this property. So again, we're going to create a new journal entry. And we'll say we did it at the 1st of February. And now we're basically just creating a new loan. So here's another example. Oops. Don't want my big face in there. So hopefully you can read this all right. So now we're creating a new loan, and this part is pretty simple, but you'll see, like in this case, there's a few different things that I didn't even know how to do it until I came across it. So we're going to create a new loan, and this is going to be now a long-term liability. So we're going to name it the property 123 main loan as a long-term liability. And the reason I like to have this specific loan is so I can actually reconcile the loan accounts. So we're going to credit this. This is the 262,500. And this is our mortgage loan now. So this is now a long-term asset, and probably like a 30-year loan. And then now we're going to do the same process. We're going to put in the closing costs. Okay, so those are loan charges. And then, so now we're in pounds, and this is the actual escrow account for the long-term loan. And so this will be, you want to create a tax and insurance escrow, parent account. And then I'm doing the same exact thing. I'm creating a sub account with the specific property because I want to reconcile the escrow account as well. So whenever you see in pounds, that's the escrow account. So we'll add this in there, 793.92 plus 328.41. All right, and then we have our normal closing costs. So we'll quickly go through this. $665. All right. So we could just name this settlement and recording fees. So now we have our payoff. And so when we look at the loan, we have the 196,650. So we know for sure that we need to zero out this loan because this is getting paid off. Even though this amount is more, we're going to put in this amount first. So we have the construction loan payable and the 196,650. Now most likely, whatever this amount is, it's going to be maybe part of the escrow if you didn't take a full draw, and then the rest is going to be like interest payments, loan fees, anything like that. You could probably call the title company and get a separate form that shows the breakdown of the remaining amount that was added for fees. But in this case, we're putting it as a closing cost. So we have 199,498.35 minus the 196,650. So that's the remaining amount from this total. Okay. We'll do 123 main. All right, so this reserve account is basically what they're doing is pulling funds into like another escrow account and they're going to pay the first 3 months of the mortgage themselves. Probably just as a liability, but whatever the case is, they're pulling that money. So you need to create some sort of current asset account. And then we'll do 54, 32, 66. Okay. And I'll show you how that works as well. And then this is a cash out refinance. So that's pretty much the purpose of a BRRRR strategy, is you renovate it and hopefully get money back, so then you can put it towards another property. And so this will just go into the checking account, and that should match 49 251 58 due to borrower. Okay, and then you don't even need a class for that one. And that's pretty much it. So we'll save that. This is the same thing. You know, you'll get your deposit. You want to make sure you match it to that journal entry. Okay. And then when we look at the balance sheet now, our escrow, construction escrow, is at 0, regardless if you pulled all of it or not. If there is some left over, you know, you want to make sure, like on that loan payoff, you want to zero out the escrow. We have now our prepaid interest reserve account that's going to be used to pay the mortgage for the next 3 months. And then we have the actual long-term escrow account. So that's the beginning balance. So that should match on the loan statements. We now have our full asset here that will be depreciated. And then you'll see our construction loans payable is at 0, and now we have our long-term liability loan at 262.25. Okay. And then, you know, the last thing, if you do have this prepaid interest, once you get those loan statements, it should show the payments coming out of that escrow account. So all you would do is just do another journal entry, because no money's coming in or out of your bank account. It's just coming straight from this escrow. So we'll just say on the 1st of March, escrow reserves, doesn't matter what you label it. Then we'll have this prepaid interest, and then the asset's going to go down. So let's just say 54, 32, 66. Divide that by 3. So that's most likely going to be the amount that they're going to take out for the first month, and then, you know, the next 2 months will be the same. Make sure you have the class. And then this would be just the normal way you would do it from the bank feed if you're paying the loan off. So we have the 123 loan long-term liability. So this would be the principal. So we'll just say it was like 315.85. And then you should have like a mortgage interest, which would be like a cost of goods sold. And we'll just say this was like 1350. And then the rest would be towards that escrow account. So here's your 123 escrow, 145, and then and then that should match. So we'll save this. All right, so yeah, so you'll see the interest reserve going down, and then your escrow account should match for that month. So that's why I like to have those so you can reconcile it. And then your loan is going down because you're putting in the principal. Okay, and then you should be able to see the interest. So you have the interest on the P&L, and then everything else would come into your P&L throughout the year. But yeah, I think that pretty much covers all of it. Hopefully that was helpful. If you guys have any questions, feel free to reach out. I know this is kind of a longer video, but that's pretty much the whole process through a BRRRR strategy construction type of process for an investor. I will leave, my socials, pretty much my Facebook, if you guys ever want to message me if you need any help. But otherwise, I will see you on the next video.